so here's an example of your problem, and I'm going to just look at the first couple of lines to get you started on what is required here. Now, the first thing that you need to note specifically is that we are using the FIFO method. That means first in, first out. So what we're trying to accomplish here real quickly is to determine the cost of the merchandise that we sell and also the inventory that we have on hand at any particular point. And the reason why we have these cost flow assumptions, FIFO, Lifo, weighted average, etc., is because in the real world it's impossible to keep track of the cost of the inventory that we have. For example, if you think of a gas station, so they bring in these big tanker trucks and they're dumping gas into the holding tank. Well, they don't run it completely dry every time they refill it. So you might have gas in there that costs, you know, gas changes every day, $2.50 a gallon to the gas station. And now we're adding more gas that costs $2.76 a gallon. So when somebody's pumping it into their car, it's impossible for us to know how much of that gas cost $2.50 and how much was $2.76. So in accounting, we have these cost flow assumptions. So we just make some assumptions so that we can do this. So all this table does is help us organize this information so we can keep track. So we've been given this information that we had a beginning balance, and I'll put this in inventory on hand of 85 units that had a cost. I'm just copying it straight down from what is provided above, $9.35. So on May 2nd, the most important thing, I haven't sold anything. I already know right away I'm going to have 85 units that had a cost of $11 per unit. For a total, you multiply those two together, you get $9.35. And now I'm purchasing 75 more units. This time the cost went up, which happens quite frequently, to $15 per unit. So in my inventory on hand, I not only have 85 units that cost $11, but I also now have 75 units at $1.15. So I can tell you on May 2nd, this is what I have on hand in my inventory. And we're going to do the exact same thing on May 3rd. And again, you have to re-copy it down. You can't be lazy and say, oh, well, I already see that this is in my inventory. No, take a few minutes, re-copy it down, and I'll tell you why when we get to the next part of the problem. It's so important. And I have been doing this long enough that I know students don't like to take the time. Okay, so at the end of May 3rd, this is what I have in inventory. So all of your problems will start the same, FIFO, Lifo, weighted average. What's important is when you actually go to sell the units. Well, weighted average may be slightly different, but for FIFO and Lifo, they will start the same. So on May 10th here, we sell 75 units. So I'm going to sell 75 units. Sales price is irrelevant. This is my revenue. So when I record my revenue for the sale, this is what I will record. This doesn't tell me at all with knowing the cost. So I can run through that journal entry with you real quickly when we're done here. But so I'm going to sell. This is for purchases. No, I don't need to fill that in. Cost of goods sold. This is extremely important. Selling 75 units, first in, first out. Well, this is what I have in inventory. What does first in, first out stand for? Well, the first items in, I assume to be the first ones to be sold. Assume. It doesn't necessarily have to follow the actual physical flow of inventory, but this is what we are assuming under FIFO. So if I'm going to sell 75 units, well, amazingly, I have 85 available for sale. This was the first in, so I'm assuming 75 of those will be the first out. So that means 75 times 11 is 825. All right, so that leaves me, if I had 85, I sold 75, that leaves me with 10 that had a cost of 11. And I guess that's 110. And then we still have 75 that I purchased for 15. and that is 1125 and 70 at 14, which is 980. Okay. So now let's ignore this problem. Let's say I'm going to sell 25 units. Well, first in, first out. The first ones I sell would be these 10. So I would write 10 at 11. And do the math. That's, I guess, 110. And then I would have to get 15 more. That would be total of 25. My next group of purchases was at $15. And then I would go ahead and carry that over. That would leave me with 60 at 15 and 70 at 14, so on and so forth. So hopefully that'll get you going. Now under LIFO, last in, first out, the last items purchased become the first ones out. So in this case, if I was selling 75, I would have to sell 70 at 14, but that's not 75. Then I have to come up to the next group that was purchased, take 5 of those and sell those 5 at 15. So hopefully that'll get you started. And then just real quickly, I mentioned the journal entries here. So if we're going to sell 75 units, under a perpetual inventory system, you have a 2-part journal entry. So the first part would be to record the sale. So 75 times 11 is 825. So I would debit my cash or accounts receivable for 825 and credit my sales revenue. That will go on my income statement as revenue. And then I need to take it out of my inventory. So I will credit ending inventory $825 and debit my cost of goods sold $825. This is why it's so important that we can figure out this number. Also, I can now see what I have in my inventory. So if I were going to add up these 3 lines, it doesn't want to do that for me, but if I were going to add up those 3 lines, I will tell you that I have now 155 units in my ending inventory, and those are valued. If I add those 3 together, that will be the cost of my inventory. That's what I would see on my balance sheet. So this question really has a lot of good information, and you can see here it asks you for cost of goods sold, ending inventory, and gross profit. Hope that helps get you started. Thanks.